Today we are going to look at the debtors collection schedule, which is also called the debtors budget. So, like I said, in order for the business to succeed, the business has to plan. Okay. So, in this case, we are doing the debtors uh, collection schedule. So, what the business is actually doing, the business is budgeting for their debtors. Okay. So, the business is budgeting that. How much will they be receiving from their debtors? You need to remember that the debtors, these are the people that owe the business money. Okay, so what happens? The business sell their goods on credit. Okay, the business sells their goods on credit to who? To the debtors. Sold goods on credit. So the business sells the goods on credit to their debtors. So what does this mean? This means that in a debtors collection schedule, we focus on the credit sales because we are talking about the debtors. So we do not consider the cash sales because they do not affect the debtors. Remember, we have two types of sales. We have the cash sales when the business sells for cash. We have the credit sales when the business sold the goods on credit. So in this case here, we are talking about the debtors collection schedule. So here we focus on the credit sales. Okay, so now we want to know that how will the business be collecting the money from their debtors? So every business has its own policy. Okay, the policy of the business should determine the term of the collection of debtors. Okay, so actually, what are we saying here? We are saying that when will the debtors pay? Within 30 days or within 60 days? It's up to the business policy. Another business policy can say that it is expecting its debtors to pay within 30 days. Or another one, it can say that it is expecting its debtors to pay within the period of 60 days. That is a debtors collection schedule. Okay, so let's look at the following example so that we can look at the debtors collection schedule. Okay, this is an example. We have the business name. It is called the Dolly Traders. So Dolly Traders credit sales were as follows. Remember, I said that in a debtors collection schedule, we focus on the credit sales. So meaning that if you are given the cash sales and the credit sales, you must only use the credit sales in order to prepare the collection schedule for the debtors. Okay, so we are given. So if you can see here, we have the actual and the budgeted. So what does this mean? This means that these are the actual credit sales for January and February, the sales that have already happened. So this means that the business has already sold the goods on credit on January and February. That's why we have them here under actual. Okay, and then we have the amounts here under budgeted. Okay, so this means that the business is budgeting that in March, April, in May, they are expecting to set the goods on credit for this March. So on March, they are expecting to sell the goods on credit for 39,000, on April for 60,000, on May for 24,000. Okay, so budgeted and the actual, that is their difference. Okay, so debtors. So debtors usually settle their debts as follows. So they are saying, Guti, in this business of dolly traders, in this business of dolly traders, the debtors they usually settle their debtors um, as follows. Okay, they are saying that the first point, 50% during the month of sale. So they are saying, Guti, what happens is that 50% of the debtors, 50% of the debtors, they settle. Okay, okay. So they are saying, Guti, the debtors usually settle their debts as follows: 50% during the month of sales. So meaning that in the month that the transaction happened, or in the month when the business sold, or in the month when the sale happened, 50% is paid by the debtors in the first month. In the month of sale, 50% is paid by the debtors. So meaning that, for example, this means that if the business sold the goods on November on credit, so what is going to happen is the debtors they are going to pay 50% of that amount in November, because that is how the debtors of this business do. They pay 50% of the debt during the month of sales. So meaning that when the when the business sold the goods on credit on January for 32,000, 32,000, I mean 50% of this 32,000 was paid by the debtors on January in the during the month of sales. And then the second one, 30% during the month following the month of sales. So now they're saying that in the in the next month, or in the month following the month of sale, the debtors they're going to pay 30%. Okay, so meaning that because the business here on January sold the goods for 32,000 on credit, in the next month after January, which is February, the debtors they will pay 30%. In January, they will pay 50% during the month of sale. Okay, during the month following the month of sale, meaning this after the month of sale. Okay, and then 18% during the second month after sales. During the second month after sales. So the second month after sales, so this is January, right? This is January. So the second month after sales is this is 1, 2. So the second March, the second month after sales it's what? It's March here. So they will pay 30, they will pay 18% here. Okay, the second month after sales. And then after that, they are saying that 2% is irrecoverable, which is the bad debt. Okay, so, and then the question is as follows. The question is saying calculate the expected collection from debtors during the budget months of March, April, and May. Okay, we are told to do the debtors collection schedule. Okay, let me just draw the format first. Let me just draw the format. Let me just draw the format. Okay, the format, debtors collection schedule. This is May, April, this is March, so we have what you call the credit sales. The month, so the first month is January, and then it's March, April, no, it's not March, January, February, sorry, it's January, February, March, April, May. Okay, so let me just finish up. Let me just finish up. Let me just finish up. Yeah. So the credit says as follows. For January, it is 32,000. February, it is 3,000. They are given above in the table. And then for March, it is 39,000. And then for April, it is 60,000. And then for May, it is 24,000. Okay, so now let's go back to this. So we are told to only do the debtors collection schedule for March, April, and May. That the business will collect how much from the debtors in March, April, and May. Okay, so now let's come back to this. Let's come back to this. So we are told that during the month of sales, 50% will be paid. Okay, so this is January. Okay, let's do it like this. So we are told that in the month of sale, so this is a month of sale, the first month, and then we are told that 30% during the month following the month of sale. The next month, the month that is following the sale. Okay, this is the second month. I mean, this is the first month after the sales. Okay, and then we have 18% the second month after the sales. Okay, that is what they are saying here. Look at this. Look at this. Look at this. 50% in the month of sale. Okay, 30% during the month following the month of sale. So this is the first month after the month of sale, which is 30%. Okay, and then 18% during the second month after sales. Okay, I made an example with January that these credit sales of 32,000. Okay, let's do it like this way. This credit sales of 32,000, 50% will be paid in the month of sale, which is January. 30% will be paid in February, which is um, during the month following the month of sale. So if the month of sale here is January, the month that is following January is what? Is February. So meaning that in February, 30% will be paid by the debtors from this 32,000. And then here in January, 50% will be paid. And then in March, only 18% will be paid. Okay, only 18% will be paid. Okay, so we are doing the debtors collection schedule, so we won't consider that. We won't consider the bad debts. Okay, so now what does this mean? This means that if we are going to start here in January, the credit sales of January, remember we have 50% in the month of sale, 30%, 18%. Okay, so let's do it this way. Okay, so if we are going to start here in January, so the goods they were sold for 32,000, yes. So in this case, because we are here in this month of January, so in this case, January is the month of sale. But then here we are told to only do the schedule of March, April, and May. Okay, and then the month following January is what? It's February. So meaning that in February, 30% will be paid in this 32,000. The month following, the second month after sale is which one? It is March. Okay, so it is going to be March, meaning that from this 32,000 in March, they will receive only 18%. So now, obviously here, we have to calculate it because we are told to do the collection of March, not January and February. So I'm going to say 32,000 times 18%. 32,000 times 18%, which is going to give you 5,760. This is the collection for March. The debtors in this 32,000, they will pay 5,760. Okay, so we are done for February. We are done for January. Now we move to February. Let's move to February. Okay, let's erase this. So this we are going to do this. Okay, so the second month now is February. Okay, now in this case, because now we are in February, we are considering February as the month of sale. As the month of sale of how much? Of 33,000. That in February, the business sold the goods on credit for 33,000. So the month of sale for February, so February is a month of sale when the business was selling the goods for 33,000. So this means that here in February, when this business sold the goods for 33,000 in February, these debtors they paid how much? Because you are told during the month of sale they pay 50%. So this means that in the month of sale, which is February in this case, the debtors from this 33,000, they paid 50%. Okay, and then during the next month, the month after sales, which is 30%. So the month after February is what it is March. So during March, they paid how much? 30% from this 33,000. Okay. Okay, and then the second month after sale. So the second month after sale, which is 1, 2, which is April. The second month after sale is what? It is April. So during April, from this 33,000, the debtors, they paid 18%. Okay, so they paid for March from this 33,000, and they also paid for April. Luckily, we are told to do for April. So this one, February, we won't calculate for it because we are not told to do for February. So it's how much? 83,000. 83,000 for March. They are paying how much? 30%. How much is that? It is 9,900. So for March, the collection is 9,900. The debtors in February, the debtors, the debtors are expected to pay 9,900 here in March. Okay, and then 33,000 again. They are told that they are going to pay 18% in April. 18%. So which is going to be 5,940. This is April. This is April. This is March, which is 30%. So it is 5,940. Okay, now we move to March. March, the credit says they are 9,000. Let me first remove this. So that we can do this thing, and then okay. Now we are going to March. Remember, I said that we don't consider this 2% because we are doing the debtors collection schedule. Okay. Now, April. Now we are in March. So in March, the business sold for how much on credit? For 39,000. So in March, when this sale happened of 39,000, so this sale of 39,000 happened in which month? It happened on March. This sale of 39,000 on credit, it happened on March. This sale of 39,000, it happened when? On March. Remember, we are told that they pay how much during the month of sale? They pay 50%. So meaning that here in March, we are going to receive 50%. And then the month after sale, okay? The month after sale, during the month after sale, okay? The month after sale is going to be what? So it's March, so it's going to be April, because the month after March, it is April. So during April, from this 39,000, the debtors, they are expected to pay 30%. Okay? The debtors are expected to pay 30%. And then the second month after sales, also, which is going to be what? After April is going to be May. So in May, they are expected to pay 18%. Okay? In May, they are expected to pay 18%. So now let's come March. So in March, so we are here. 39,000 times 50% for March. This is for March, right? 39,000, which is going to give you how much? 19,500. So in March, it is how much? 19,500 for the 39,000. Okay, and then April, they're expected to pay 30%. So 30% is how much? It is 11,700 in April. 11,700. Okay, and then now in May, they're expected to pay 18%. So 39 times 18%, which is going to give you 7,020. Okay, 7,020. Okay, let me erase this so that we can continue. So that we can continue. Okay. Now we're in April. In April, the sale was how much? It was 60,000. So 60,000. So April, for 60,000 of credit sales, April was the month of sale because this sale of 60,000 happened in April. So this means that in April, the debtors, they are expected to pay 50% from this 60,000. Okay, and then in the month following the month of sale, they are expected to pay 30%. So the month following April is what? It is May. So in May, they are expected to pay 30%. And then the second month following the month of sale, they are expected to pay 18%. So in June, they are expected to pay 18%. So unfortunately, we are not doing for June, we are doing for March, April, May. So we're going to focus on April and May. Okay, so how much is this? 60,000 times 50% for April. So we're doing for April right now. 60,000 times 50%, that is 30,000. So in April, we're going to have 30,000. Okay, and then in May, it is 30%. So 60,000 times 30%, which is going to give you 18,000. So we have 18,000. Okay, so it's like this. Now we move to May. Okay, let me erase this. Let me just erase this. Let me just erase this. Okay, and also this, and also this. Okay, in May, the credit says they are 24,000. So in this case, May is the month of sale for 24,000. May is the month of sale. So we are told that during the month of sales, they're expected to pay 50%. So in this case, the month of sale is May. And then the month following the month of sale, so the month following May, it is June. Unfortunately, we're not doing the one for June, we're doing for March, April, and May. And then 18% second month following the month of sale, which is going to be July. Unfortunately, we are not doing for July, we are doing for March, April, May. So we are going to focus on May. So it is 24,000 So we are told that they're going to pay 50% for May, which is going to be 12,000. This is going to be 12,000. Okay. This is going to be 37,020. It is going to be 47,640. It is going to be 35,160. Okay. So we are done with the debtors reconciliation. This is the collection of debtors. Now, when we are doing the cash budget, under receipts, let's say this is your cash budget. You are doing for April, you're doing for March, April, May. So in your cash budget, you are going to have under receipt the collection, because the collection of debtors, these are the receipts we are receiving from our debtors. On May, the debtors, they are expected to pay a total of 35,160. On April, they are expected to pay a total of 47,640. In May, they are expected to pay the total of 37,020. So then this is your, so it's not complete. I'm just showing you this portion of the cash budget and the receipt, because this is a receipt. Okay,